Hi everyone, I'm Noha. I'm here with my partners Eric and Ming. We're going to be comparing Adidas and Nike through different ratios and financial analysis.
Let's start first with the Adidas background. Adidas is a public company and it focuses on manufacturing leisure apparel, footwear, and sports equipment. Adidas is now selling its product in more than 160 countries. Now move on to Eric.
I'll talk about the background of Nike. It is one of the largest athletic suppliers founded in 1964. It designs and markets various products, both casual and athletic. It has many distribution channels such as third-party footwear stores and also its own retail store and digital platforms.
We chose these companies firstly because these are companies that we interact with regularly and we are familiar with them. Secondly, we found them to be very close comparables, which would make our evaluation and analysis a little bit easier. Moving on to the efficiency ratios, which Eric will now explain.
I'll discuss working capital turnover and inventory turnover today. One captures how companies exploit each dollar or euros of working capital, and the other tells you how quick they sell their inventory. So let's go back to the Excel to talk about some interesting change. In 2018, when Nike increased, Adidas experienced a decrease in working capital turnover. With sales being similar, working capital has a big increase from 2,000 to 2,700 millions. And it is due to an increase in total asset. So I assume the company might not exploit them well as sales didn't increase, causing a lower turnover. And for sure, we noticed that both ratios decreases in 2020 due to COVID and decreased sales. Overall, Adidas has a higher working capital turnover than Nike each year, seems to indicate higher sales. However, by comparing sales and working capital, we can see that actually Nike has higher sales even after changing currency, but the turnover is still low due to its high working capital. As you can see in the bottom, one has average of around 10,000 millions and one with 2,500 millions. For inventory turnover, both seem to have similar trend overall in the blue shaded area, but Nike tend to perform better, maybe because of its better marketing strategy. Let's pass to Ming.
Now I'm going to talk about debt ratio, which is used to measure the amount of leverage a company uses. From the calculations, I noticed Adidas and Nike have the similar debt ratio of around 60%, which means the two companies have similar capital structure with debt accounting for 60% of the company total assets. Move on to current ratio. Current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations. On average, Nike ratio is 2.55, which is higher than Adidas ratio 1.38. This indicates that Nike has a better position of paying its short-term debt than Adidas. Now know how to explain the profitability ratios of the two companies.
So the profitability ratios I'll be going through are earnings per share, which explains how much money a company can earn per common share outstanding, and the operating margin, which represents how efficiently a company can generate profit from solely its main business activities. So looking at earnings per share, I have Adidas at the top and Nike at the bottom. The first thing that stands out very obviously is that Adidas has a much higher earnings per share throughout the 5 years compared to Nike. This is because Nike does have a much higher market capitalization, which means they would likely have more common shares outstanding, which is why their earnings per share is so low. The second thing that stands out is in 2020, both companies take a hit to their earnings. This is because this is the same year that COVID first hit, so it makes sense that both companies experienced decreased sales. However, for Adidas, this decrease is much more significant because they did have a tougher time. However, in 2021, both companies were able to bounce back even better than they were before. Moving on to operating margins, again, I have Adidas on the top and Nike on the bottom. First thing we can see overall, both companies are performing well, able to generate good profit. However, Nike's operating margin is higher than that of Adidas. And this is this I believe is because Nike's higher innovation. They're able to have more innovative, more unique products, attracting more consumers, being more popular, allows them to generate more profit, and again, maintain their high market capitalization. So passing it on to Ming to explain the DuPont analysis.
Okay, so the DuPont analysis is a technique that we use to decompose the return on equity into three different components, including net margin, asset turnover, and equity leverage. The return on equity will tell us how well a company can generate income from its equity. On average, the return on equity of Adidas is 21.16% over the 5 years period from 2017 to 2021, with a dramatic drop to under 7% during COVID time in 2020. Move on to the next slide. The return on equity of Nike, however, fluctuated over 5 years period, but the overall trend is upwards and the average is about 35%. Now I'm going to compare the Nike and Adidas return on equity. So it's obvious that we can see the return on equity of Nike is much higher than Adidas except in 2018. The reason for that is because in 2018, the net income of Adidas dropped by half because of the increase in effective tax rate to 55%. But the overall higher return on equity means Nike is better at generating profit from its equity. Comparing graph 1 and graph 2, we see that the return on equity trend and the net margin trend is pretty similar. This is because the net margin is the most volatile component of return on equity. On average, the net margin of Nike is higher than Adidas by 3%, indicating Nike has better profitability. The reason is that the operating margin of Nike is 12.47%, significantly higher than Adidas, at just 8.92%. As my partner explained earlier, with technological innovations, Nike was operating more efficiently with low operating expenses. In graph 3, we see that at the beginning, the asset turnover of Nike was just slightly higher, but the gap between two companies increases consistently over 5 years. Lastly, graph 4, we see that both companies show the average equity multiplier at around 2.5, meaning that 40% of the company's total assets is financed by shareholders' equity. Now, Noha will keep explaining about the dividend discount model.
So for the dividend discount model, I have here Nike and Adidas. What I did is I took the dividends paid out from 2017 to 2021, and I calculated the percentage change between each year. From that, I averaged out these values to get an average to use as my growth rate, which I used to project dividends to be paid between 2023 and all the way to 2027. From there, I calculated a price for 2026, added it to the dividends, and then discounted it back to arrive at a price here for 2022 using this discount here, 8.8%. I did the same thing, repeated the same process for Adidas, and as you can see, the price for Nike is $65.34, and for Adidas, $24.51 is very far off and not consistent from what the companies are currently trading at in the market. And I believe this is due to drawbacks with the dividend discount model. It relies heavily on assumptions, mostly with the discount rate and the growth rate, and any slight mistake in either of them could cause the price to be very far off from what it should be. So perhaps this discount rate, which I found from other analysts, was a little bit far off. Perhaps this isn't exactly the way the company projects its growth to be. So this is what caused the growth rate. This is what caused the price to be far off. So now I'll pass it to Eric, who will explain the valuation through multiples, hopefully to arrive at a more reasonable price.
For multiples, I compare with Puma, Lululemon, and Under Armour, which are 3 major competitors in the industry. I use 4 ratios, PE, PS, PB ratios, and price per cash flow ratios, which compare each company's share price with their forward EPS, sales per share, book value per share, and cash flow per share. Then I took the highest ratio and lowest one of each of them and applied to Adidas and Nike. For example, price to sale multiples, using the highest of Lululemon and lowest of Under Armour and times with sales per share of 109 of Adidas, it gives us a range from 191 to 719 euros as highlighted. After that, I put ranges of all 4 multiples together and find the overlapping range to determine the reasonable price. As we can see in the slide, it gives us a range for a price range of 237 to 581. However, it doesn't match with price today because most data is from December 2021, such as sales per share. So we should compare with price that time, which gives a more matching of 251. And I guess today's price is lower because the investors are less confident than last year. Same to Nike, though today's price fits the range of 52 to 107, it more suggests a price in May of 115. We'll sell at that time for sure since it is higher. Price today indicates maybe investors have similar confidence in May. To conclude, I guess this is the drawback of multiples, that we need more recent data to determine today's price.
Thank you for listening.
Thank you.